Yo, what's up, guys? How you doing? Good evening. I had some of you guys asking me for a Fibonacci video, and let's get to it. I'm going to be giving you guys a little back history on the Fibonacci, and using it with some examples. And let's get to it. Give me a quick second here, and here we go. All right, guys. So the Fibonacci was created by a mathematician hundreds of years ago, and it wasn't actually created to be used as a trading tool. And it was actually forgotten, and then hundreds of years later, traders started using it, and it's highly used now by professionals, Wall Street, hedge funds, you name it, whales, whatever the hell you want to call them. But it's a highly used tool for trading now. And before I get into more details, a lot of people keep asking me why these indicators work, and it's quite simple. You have to understand, like, the moving averages, the EMAs, the MACDs and RSIs, and the Fibonacci that we're going to be touching on today. These are tools that are used by millions of people around the world, and what happens is that they're taught, right, the same thing. So they become reactive, because if everybody is taught the same thing, and it's used by millions of people, now we can assume, right, and we can see every single day that these indicators work. So that's why indicators work. They don't work all the time, right, because nothing in trading is 100%, right? But the Fibonacci is one of those tools that it's pretty effective. I don't know the percentages of the effectiveness, that it has when using it, but they're pretty effective percentage-wise. It's pretty high with one of the besides the MACD, which is the other highly high profitable, in the sense that that it's pretty accurate. So I don't know the percentage exactly, but I do know that the Fibonacci is highly accurate as one of those tools. So let's get to it. The Fibonacci levels that I like to use are the 0.706, the 62, and the 0.79. Those areas are known as the golden zone, right? Those are the areas that we look for continuations. We look for reversals, etc., etc. So I'm going to be marking up. I'm going to open up my Fibonacci here, so you guys, if you want to use it, you can definitely see it here. But yeah, I mean, it's the 50, the 62, the 79, and those are the zones that I use when I'm looking to draw zones, or when I'm looking to get into a trade. And that's basically what those are the zones that I use. The time frames that I use the Fibonacci. I use the Fibonacci in the 4 hour, the 2 hour, the 1 hour, right? And those I only use to mark up my zones. Heavy zones that I know that they're probably going to be highly reactive. And that's basically what I do use the Fibonacci for on the higher time frames, is to mark up my zones. But as day traders, I only use the Fibonacci in the 15-minute. I know of guys that use it in the 5-minute. I do not advise it. I only advise using the Fibonacci in the 15-minute, right? A lot of the other thing that I wanted to touch upon is that I've seen a lot of you guys drop your TAs, and some of you are using your Fibonacci incorrectly, right? You're drawing the highs to the lows, or the low, the low to the highs, and you're drawing up the zones incorrectly, and you're drawing the Fibonacci incorrectly. So let's say right now, and I'm going to give you a couple examples as day traders how you could use it, and then I'm going to walk you, and I'm going to show you how I use also my EMAs to give me that extra confluence. And then if you combine both of them, the Fibonacci with the EMAs, it works perfectly, right? And it becomes a great system, and I'm going to show you that. So let's say right now you got into the market, right? And you see this here. You got into the market here, right? But you look at the trend and you say, well, it's a downtrend, right? I'm looking at, on the 15-minute, it's a downtrend. And I'm a day trader, so I'm looking for a quick move, right? I'm looking for a day trade. So I missed this move here, right? And I want to see whether it's going to continue, right, for a reversal and knock this out, this high over here, or if it's going to just continue to go down and probably target, a zone to your left. So what you do is, if you look, you'll come over here and you draw your fib here, right? Starting here, I'm sorry, you draw your fib up from the high because you started here, you missed this move, you missed this whole move, and now you start drawing your fib from the top, right, to the bottom. So once it cleared out the zone here, it couldn't break this here. So what you do is you draw it out, and you say, all right, let's go ahead and draw it out, and let's see if it's going to continue or it's going to go down, right, for continuation bearish with the general trend that we see here. And what do you see here? A perfect 0.5 of 50, a rejection off the 50. So this would give me an indicator of, okay, so the trade wants to go ahead and keep going down here. The trend wants to continue to go bearish. And then once you identify that, then you can use that with your EMAs, which is, I use the 50 and the 200. And what do you see there, guys? A perfect rejection. Perfect rejection. So now you have double confluence. Now you have two indicator giving you positives that this is going to be a move here, right? There's going to be a bearish move, a bearish play. So you would go ahead and open a sell position, okay? And you can obviously target this area. And let me see here. Obviously, you'd be targeting this area here. And this area here, right? So that's how you would use it. Another example. Let's say you came in here, right, and you see this move here. Quick second, let me erase this here. Now I'm going to get confused here. This move. Right. You came in here and you saw this move. Couldn't break trend. And you want to see if it's going to go down or it's going to go up. What would you do? You go here and you draw your fib 1, starting all the way down, and you're here. And you'll be following your trade, right? And obviously you'll be looking to see if the market was going to break this here or if it's going to break this high here. And guess what? It did. And then now you'll wait, and what do you see? 0.62, right? And what did you see? Pull back. But what do we have here? A 50 and a 200 moving average with a cross, right? This is your move, targeting this area right here. And if we continue, we have another play here, right? You'll come in here. You saw this move here, right? You saw this move here, and you're here now. Okay, all right. So this move went up, couldn't break this trend line, couldn't break the zone that you had here already marked up. Chances are that you already had marked up. It couldn't break it. So what do? Okay, so you're here in the morning. You go here, you draw. Okay, what's the previous high? You draw, come down, and then you would want to see if it's going to continue or go up. What do you see here? Right, you have your moving averages. Okay, it couldn't even break the 50. It couldn't break the 200. And then on top of that, what do you see here? A rejection off the 50%. And another trick is that when you start using moving averages and you start seeing the moving averages start gapping out, you see this gap gets bigger and bigger and bigger. You can write this down, right? Because now you're seeing these moving averages, the more separate they get from one another, that gives you an indication that the trend is pretty strong, right? Either being bullish or bearish, and in this case is bearish. Now you move over here, and we'll go for another example. You wake up in the morning, you're here, right? Okay, so what happened? What's the lowest low here? Over here. Okay, so to start it out, you go over here, 1 all the way to the top, and let's see. What do we see here? Let's move this to the side. 0.62 rejection. See that? 0.62 rejection. And what do we see here? The 200, it's above the 200, right? And then obviously you will see this rejection here, the 0.62, and then you will wait to break. Let me open this up here. Give me a quick second here, guys. To break these highs here. And what do you see? This gives you enough confidence. 0.62 rejection, 200. It's on top of the 200, on top of the 50. It broke previous high. Bam! You take your trade, and you'll be targeting obviously these highs over here. So basically, you know, that's how you use the Fibonacci's for intraday trading or day trading, and it gives you great moves. Like I said before, I know guys using it in the 5-minute. I know guys using it in the you know, 1 hour, 15 minutes. My preference as a day trader is the 15 minutes for me to catch a move for day trading, but I also use it on the higher time frames, the 4 hour, the 2 hour, the 1 hour, to mark up major areas that I'll be looking for a reaction from those you know, those important Fibonacci numbers. So yeah, I mean, that's the Fibonacci, and don't use the Fibonacci by itself. Use it with you know, in confluence with other things. I like to use it with the EMAs because it helps me with my trade idea, and it gives me that extra confidence for me to get into that trade. So yeah, I want to keep these video shorts short. I don't want to, you know, drive you guys too crazy. And yeah, just give me more ideas of what you guys would love to see. If you have any questions, feel free to reach out to me. All right, guys, I appreciate it, and I'll see you guys soon. Later.